Almost everywhere online, more people are echoing the sentiment that we live in a generation struggling to keep their heads above water financially. In forums, social media posts, articles, and even in conversations at family gatherings, you'll hear it. They just don't know how to manage money. They're too lazy to work hard. Others argue that the blame lies with a broken system, rising housing costs, staggering student loan debts, and a job market that seems designed to keep young people stuck in low-paying, precarious positions. These discussions are not just empty chatter. In fact, statistics seem to back up the idea that this generation is facing challenges unlike those any other generation has seen before. According to a report by Deloitte, 40% of young people feel that their financial situation is worse than their parents, with soaring living costs, an ongoing housing crisis, and a student debt crisis reaching over $1.7 trillion in the United States alone. It's clear that many young adults are feeling the strain. A study by Bankrate revealed that nearly 40% of Gen Z have less than $100 in savings. And if that wasn't enough, the rising cost of living in cities, coupled with wages that aren't keeping pace with inflation, has left this generation scrambling to make ends meet. There are reports of individuals juggling multiple side hustles, taking on gig economy jobs, and still barely scraping by. Yet the traditional path of securing a well-paying, stable job post-graduation, which used to promise upward mobility, seems increasingly out of reach. Some blame the so-called culture of instant gratification that social media has fostered. Influencers flashing their wealth, luxury brands, and the hustle culture has created an environment where this generation's financial habits are constantly under the microscope. Is it really a matter of poor money management, or is it the consequences of an economy that seems to favor the wealthy while pushing the rest to the brink?
If you were to walk down the street right now, I want you to look at this. About 1 out of every 6 people that you pass could be living in poverty. Many of them are children. That is the brutal reality, according to the latest numbers released by the Census Bureau.
A record number of Americans are so poor, they would have to see their incomes double just to reach the poverty line.
Americans are sort of looking at how much money they would like to have to be financially secure, and that ends up being basically 3 times what the average income is in this country. And to be essentially wealthy or really successful, it's magnitudes above that.
You're broke! You're poor!
In the early 1990s, the United States was riding high on the success of the previous decade. The end of the Cold War in 1991 opened up new global markets, and the advent of the internet gave birth to what many called the information age. The stock market boomed, and the economy seemed to be on an unstoppable upward trajectory. Unemployment was low, and wages were rising in many sectors. For many, this appeared to be a period of prosperity. Yet, while things looked promising, there were factors at play that would have long-term implications. A 1998 study by the U.S. Bureau of Labor Statistics revealed a shift in the job market. While jobs in technology and service sectors were rising, traditional industries such as manufacturing were beginning a slow but steady decline. The 1990s were a time when these early warning signs of deindustrialization were becoming more apparent, signaling that the well-paying factory jobs that had fueled the growth of the American middle class for decades were becoming less common. The financialization of the economy began to take hold. As the stock market soared, so did the importance of the financial sector, with investment banking and speculative trading growing in prominence. Corporate executives began shifting focus from long-term growth to short-term profits, often relying on debt and risky financial practices to maximize shareholder returns. This growing reliance on financial markets, rather than on physical production, would set the stage for future economic instability. The 2000s would continue this trend, but it was the bursting of the dot-com bubble in 2000 and the subsequent recession that revealed cracks in this seemingly strong foundation. The dot-com crash resulted in billions of dollars in losses, leading to a significant loss of investor confidence. Many technology startups went bankrupt, leaving their employees with no severance and plunging the economy into a period of uncertainty. Yet, it wasn't until the 2008 financial crisis that the full extent of these financial practices would come to light. The 2008 crisis was a pivotal moment in the economic history of the world. A 2010 report from the National Bureau of Economic Research found that the financial collapse was a direct result of irresponsible lending practices, a housing bubble, and the risky behavior of financial institutions, all of which were symptoms of a broader issue. the increasing dominance of finance over other sectors of the economy, as banks engaged in subprime mortgage lending, providing loans to people with poor credit histories. They were essentially betting on the continued rise of housing prices. When home prices began to fall, the entire system collapsed. This crisis left deep scars on the global economy, with millions of people losing their homes, jobs, and savings. A 2013 study from the Federal Reserve found that the median net worth of American households dropped by 40% between 2007 and 2010, the largest decline since the Great Depression. But the effects of the crisis were not just financial, they were generational. Young people, particularly those just entering the job market during or after the crisis, found themselves facing a job market that was vastly different from the one their parents had experienced. The economy was no longer a land of abundant opportunities. It had become a battleground of underemployment, unpaid internships, and precarious work. In addition to this, the rising costs of education and healthcare were beginning to be felt. According to data from the National Center for Education Statistics, the cost of a 4-year public college increased by 30% between 2000 and 2010, while student loan debt ballooned to unprecedented levels. By 2014, student loan debt had surpassed $1.2 trillion, a figure that would only continue to grow. This massive debt burden weighed heavily on the financial futures of young people, setting them back in their pursuit of home ownership, retirement savings, and financial independence. In terms of the broader economic conditions, the recovery after the 2008 financial crisis was slow and uneven. A 2017 report from the Federal Reserve showed that while the stock market had rebounded and the wealthiest Americans had seen their assets grow significantly, the median household income had stagnated for much of the population, particularly for younger individuals. The gap between the wealthy and everyone else began to widen, with a shrinking middle class and a growing concentration of wealth at the top. By 2016, the top 1% of Americans controlled 40% of the nation's wealth, a stark contrast to the 1980s, when the top 1% controlled only 25%. By the 2010s, the landscape had shifted dramatically. Many young people found themselves in a financial world where job security was no longer guaranteed. The cost of living was rising faster than wages, and the traditional paths to financial success, such as buying a home or saving for retirement, seemed increasingly out of reach. The 2008 crisis had set the stage for a new economic reality, one in which long-term stability was harder to come by, and financial opportunities were fewer and farther between. It's 2025. A new generation of workers, consumers, and dreamers has entered workforce, but instead of walking into a world of opportunity, they find themselves standing at the crossroads of financial hardship, underemployment, and overwhelming debt. The economy, once thought to be a place where anyone could carve out a path to success, has become a labyrinth of high living costs, stagnant wages, and diminishing returns on education. To understand the depth of this financial crisis, we need to first look at the economic forces that have shaped this generation's reality. The first financial burden this generation inherits is one that has only worsened in the past 2 decades: the cost of education. College tuition, once seen as the gateway to a better life, has spiraled out of control. By 2025, the average cost of tuition at public universities has exceeded $30,000 per year, and private institutions easily surpass $50,000. Over the past 30 years, the cost of education has risen by more than 200%, far outpacing inflation, wage growth, and the overall economy. As of 2025, total student loan debt in the US has surpassed $1.7 trillion, with nearly 45 million Americans owing an average of $37,000 each. The modern generation finds themselves entering the workforce with debt that can take decades to pay off, hindering their ability to purchase homes, start families, or save for retirement. A report by the Federal Reserve revealed that 30% of student loan borrowers are in default or forbearance, unable to keep up with repayments, and many will be paying off their loans for the rest of their working lives. This mountain of debt is a direct consequence of skyrocketing tuition costs, paired with a lack of real solutions for tackling student loan repayment. The system was never designed for this level of debt. It was designed for a time when college was more affordable and the economic return on a degree was greater. For most generations before them, owning a home was the cornerstone of the American dream. But now, the idea of homeownership has turned from an expectation to a distant fantasy. Home prices, which saw a rapid rise in the years following the 2008 financial crisis, have continued their upward trajectory into the 2020s. According to the National Association of Realtors, the median home price in the US hit $350,000 by 2025, an increase of nearly 130% since 2000. But wages, particularly for young workers, have failed to keep up. The median wage for workers under 30 has stagnated, growing by just 13% since 2000. In 2025, over 60% of young renters say they feel locked out of the housing market altogether. The dream of buying a home is being replaced by the harsh reality of rent, with average monthly rents in major cities like New York, Los Angeles, and San Francisco topping $2,000. The result of this housing crisis is that young people are delaying life milestones. Many are opting to rent indefinitely, unable to accumulate the savings necessary to make a down payment, while others are moving back in with their parents or seeking alternative living arrangements. According to a 2023 study by McKinsey, nearly 30% of jobs in the US are at risk of being automated within the next decade. This means that entire industries are disappearing, while new ones are emerging at a rapid pace, requiring specialized skills that many Gen Z workers don't yet possess. Even for those who do manage to find full-time work, wages have stagnated. The Economic Policy Institute reports that wages for the average worker have increased by just 12% since 1979, a rate that doesn't even come close to matching the pace of inflation or rising living costs. This has created a situation where young people are working harder than ever, or don't bother working at all. Many find themselves underemployed, working jobs that don't require a degree or pay anywhere near what they expected after years of studying and accruing debt. The rise of the gig economy, which promised freedom and flexibility, has instead created a landscape of job insecurity. According to a 2024 report by the Economic Policy Institute, nearly 20% of Gen Z workers are now engaged in gig work, temporary, part-time, or freelance jobs that often offer little in terms of benefits, job security, or income stability. The allure of being your own boss has been replaced by the reality of unpredictable hours, low pay, and no healthcare or retirement benefits. It's a financial trap that has entrapped millions of young workers. The cost of living has risen sharply across the board in recent years, and young people are feeling the effects more acutely than anyone. Healthcare, for example, has become a massive financial burden. The Kaiser Family Foundation reports that premiums for employer-sponsored health insurance have risen by more than 60% since 2005, leaving many young workers with healthcare costs they cannot afford. Similarly, the prices of everyday goods have skyrocketed. Inflation, which spiked dramatically in 2022, has reduced the purchasing power of modern wages. A 2023 survey by the Bureau of Labor Statistics revealed that workers' purchasing power had decreased by 8% in just 2 years. Everyday life has become more expensive, and young people are forced to spend more just to maintain the same standard of living their parents once enjoyed. The fundamental problem of this generation is not just about wages, debt, or job security. It's about the breakdown of the social contract that once promised upward mobility. For generations before them, the promise was simple: work hard, get an education, and you will succeed. But now, that contract has been systematically broken. The systems that once provided clear paths to economic stability, affordable education, stable jobs, and reasonable housing have been eroded over time, leaving this generation struggling to find a way forward. The financial burdens of student loans, rising living costs, and wage stagnation have combined to create a perfect storm of financial instability. And as we enter the third decade of the 21st century, it's clear that this won't be solved overnight. As things stand, the financial trap this generation has inherited looks incredibly difficult to escape. With skyrocketing student debt, a housing market that's out of reach, stagnant wages, and an unstable job market, this generation faces an uphill battle just to achieve the basic milestones of financial stability. While it's not impossible for some individuals to break through, whether through entrepreneurial ventures or lucky breaks, the systemic barriers in place make it seem like the odds are stacked against most. Escaping this trap may require more than just hard work. It might take sweeping changes to education, the economy, and the very structure of the job market. Unfortunately, unless these changes occur soon, the financial prospects for this generation remain grim.
Get my lawyer.